Thank you, everybody, for coming in and viewing our webinar. We do these every month, the Northwest Chamber. And what we try to do is bring educational webinars to our members and anybody else out there in the world that wants to tune in. They are recorded, so if there's something that you want to share with anybody after this session, please, I'll send out the link, or you can look on our Facebook page and it will be posted there as well. So I'd like to introduce Kate. Kate Strom is a financial advisor. She has a passion for helping people reaching their goals on their terms. As a wealth management specialist and an accredited behavioral finance professional, if you can hear my dog, I'm sorry. She brings a unique set of skills to her clients by understanding the actual psychology of financial decision making and helping them break down the psychological roadblocks they may even know that they have. So that's really interesting, Kate. Do you want to explain just 30 seconds on that? I don't hear
Sure.
that much.
It's a fairly new area in finance. It's called behavioral finance. There's been behavioral economics for a long time. Well, not a long time, 40 years or so. But yeah, it really just looks at why we make the decisions we make and how to get around some of those knee-jerk reactions that we do. I really love doing that because there's so much that we just push aside. And I've seen so many people not save for their future and not do what they know in their mind they should be doing because of these other roadblocks in their minds. So I really love the whole field of behavioral finance and behavioral economics is fascinating. So if you're interested in it, I can recommend some books too that
Well, that's great.
are
I've
like
never,
layman friendly books.
That's great to know. I've known you for a while, and I don't know if I've ever come across that fact about you. So thanks for
That's
sharing.
It's a newer one. I just earlier this year I received the accredited behavioral finance professional designation after doing some graduate level coursework on it. So
That's great. Great to know. Okay, I
it,
won't take up any more of your
that's
time, so let's get started.
okay. Well, thank you all for coming today. I appreciate it. Um, we're just going to talk kind of quickly about a few topics. I don't want to get too into the weeds because I could talk forever. If you've ever met me, you know I like to talk. But we're going to talk a little bit about wealth building and preserving it. Kathleen did say a little bit about me. A little more is just that, so you know my background. I graduated from Towson with a degree in economics. I joined Carroll Franklin Plotkin back in 2002, so just about 22 years, and fell in love with planning and helping people figure all of this stuff out. And decided that's what I was going to do with my degree because I had no idea at first, and then became an advisor about 12 years ago. I also recently just took over the practice from one of the founding partners. He retired, so I took over the management of the practice as well. So we're talking about wealth building and preservation today. So I'm going to talk a few different things: asset allocation, investing over time, and tax deferral. And then we're going to talk about preserving it. A couple topics on life insurance that maybe you haven't thought about before, and just a little bit on long-term care. There's a lot to cover under long-term care. So we're just going to go over some of the costs and a couple little notes on that. So talking about building wealth, we all know that we need to save the money, but what do we do? Do we just stick it in the bank? Do we buy stocks? Do we buy bonds? Do we buy CDs? If we buy stocks, which stocks? Things like that. The answer in short is yes. Do all of those things. Put your money in as many different areas as you can feasibly, that's right for your particular situation. This chart is kind of hard to see if you're actually really interested in it. I do have it as a PDF, and I'll be happy to send it to you if you want. But what I really want you to focus on is what it's showing in the colors. So each colored box is a different asset class. It's arranged top to bottom from best performing asset class that year to the lowest. and then left to right from 2008 through 2023. And you can see that the blue box at the top in this the third column over, it says fixed income if you can't read it, is the top for 2008. 2009 is second to last. What I really want to draw your attention to, though, is the white box that has that line going through it. That represents a diversified portfolio. It has all of these asset classes in it. And we see it's never the top of the line. It's never going to blow the market away. And it's never going to be the end. I shouldn't say never. It's possible. Most likely, it's not going to. What you get is a smoother ride throughout with the less chance of a major dip, especially at a time when you might need to be withdrawing money. That's the worst time, is when the market's down. So if you have this asset allocated portfolio, this is the diversification, the allocation, you're going to have that smoother ride. You're going to be able to build your wealth better. And it's just, that's part of managing those emotions and that psychology as well. It's much easier to continue in the market and stay invested when you have that smoother ride. The issue really is that besides having the smoother ride, you can't really pick just one or two areas. You can't just say, I know some people, especially younger people, are like, I'm going to put all my money in Tesla, or I'm going to put it all years ago in Microsoft stuff. And yeah, those would have been good picks for a stock, but you can't put all your eggs in that one basket. We're going to go over a quick example, and feel free to use the chat if you'd like to tell me, which of these two markets would you rather invest in? The one on the left or the one on the right? I'll give you a second to look at those. And think also, what if this was your portfolio? What if you woke up tomorrow and your invested assets, whether you have $500 invested and it's that, or 50,000, doesn't matter. If your portfolio looked like the left and you saw it going down, how would you feel? And would you make any changes? Now, probably on the right, you're probably going to be like, yeah, let's put more money in. You have it. Market's going up, right? Well, what would you feel or think if I told you they're the same market? I took those two from last year's S&P returns. They followed each other. So if you had gotten out in September, which is about that lower heading down point, it's not the lowest point, but it's heading down, you would have missed that big uptick in the market. I mean, you would have been much worse off because you had sold out at the bottom. And then were you going to get back in, or were you going to be afraid to get back in? The point is that when you're investing for the future, you have to look very, very long term. Manage that expectation of you can't look every day. It's going to go up and down. It's going to drive you crazy. But if you have that allocated portfolio, yeah, your portfolio may look like that down market a little bit, but it goes back up. So we need to keep that in mind, and we really can't time the market. So another way that you can build your wealth is to legally avoid taxes. So this is about tax deferred investing. You may have an IRA or a 401k or 403b through work. This chart is nice because it shows you the difference between if you just saved money, say in a brokerage account, which is a taxable account, or just a bank account or CDs. What I mean by a taxable account is that you put the money in, you earn interest and dividends on it. Every year, you get what's called a 1099. And you may just get it from a bank account from savings. If you have over more than $10 in a bank account, you should get one every year. You get taxed on that money every year. When you put it in an IRA, like a 401k or a tax-deferred IRA, 401k, 403b, even Roth IRA, that money doesn't get taxed that year. It stays in that account. Now, this chart we're looking at is more for traditional IRA, and I'll go over Roth in a minute. But we can see the blue section there is if you just saved in that taxed account, that bank account, that brokerage account, over 30 years, It starts with 100,000. Over 30 years, you'd end up with $473,000. You're getting taxed every year, fine, but you can take the money out whenever. The gray dotted line is the ending balance is if you started with $100,000 in a tax deferred account, or you had contributed that over the 30-year time frame. Instead of 473,000, you'd have 761. That's a significant increase in your wealth. This chart also assumes that you take at the 30-year mark, you take everything out and you get taxed on it as ordinary income. So what that means is that in an IRA, you're not being taxed, a traditional IRA or 401k, you're not being taxed each year, but when you take money out of that account into your own possession, then you get taxed as if it were income. You don't get a special capital gains rate or anything, it's just your income. So that this chart then assumes that you do that and you're in a 24% tax bracket, whatever. And you go from 761 to $602,000, which is a significant decrease. However, you're still significantly above that 473. So tax deferred investing can really increase your wealth with the same amount of money you're putting away into a taxable account. There are some nuances with who can contribute and how much, and feel free to ask questions if you want, or get in touch with me separately if you have any questions on that, that's fine. But this just illustrates that power of that compounding in a tax deferred account. So Roth accounts are a little bit different. This is the tax, kind of the taxation of things. I want you to look at the Roth IRA. If you look in the blue, it says tax-free withdrawals. So what that means, a lot of people get confused between the traditional and the Roth. So like we said before, the traditional, you don't get taxed at all when it's growing, when it's in the account. When you pull the money out, you get taxed like it was earned income. With the Roth IRA, you put money in, it's taxed when you put it in. So with the traditional IRA and your 401k, that usually gets, or that does get taken out of your taxable income for that year. So for example, you have an income of $50,000, you put $5,000 in your company's 401k, your taxable income that year that you report on your taxes is $45,000. You have to say then you get $50,000 and you put $5,000 in a Roth IRA or a Roth 401k. You're still taxed on $50,000 of income. You're taxed before you put it in. However, those contributions still grow tax deferred or tax free during the time it's in the account. And then as long as you meet a couple different criteria, it has to be in the account for at least 5 years. You have to be 59 and a half to pull it out of a Roth. You don't get taxed on that at all, including the growth. You can always get from your Roth IRA, you can always get your contribution back out because it's already been taxed. But you can get the earnings too. And we saw how significant those earnings can be. So that's another $200-some thousand in that previous example that are tax-free coming out to you. It's a significant increase to your overall wealth and your ability in retirement to enjoy the life you want to have. So let's move on here. We're going to talk a little bit about preserving our wealth. Now, I'm sure everybody has heard of life insurance. There's two different types, really. There's permanent insurance and term insurance. So permanent insurance is a lot what most people think of when you think of, oh, life insurance policy. You're paying into a policy, and when you die, it pays out. A term policy is similar, except that it has a time limit, hence term, usually 10, 20, or 30 years. The permanent policies are more expensive. They insure you for a longer period. The company's taking on more risk, insuring you for the rest of your life. Term policies tend to be cheaper. And you may have heard like, oh, you should only have term because you don't need it. You don't need permanent. It's too expensive. In practice, I find that most clients benefit from a mix of both. The permanent is for really your final expenses, administration costs for your estate, maybe specific bequests. If you have a large estate, that can be used to help offset some of the estate taxation and inheritance tax if the an issue for your descendants or your heirs. Um, Term insurance, think of more so like your car insurance. You pay it. If you don't pay it, it expires. And if you don't use it, you get no benefit. We're all guaranteed to die at some point. The permanent policy, as long as you're paying it and it's in force, will pay out when you die. The term policy, you have to die in that term. So, what's some of the uses? Have you ever thought about insuring your mortgage? Say you go out today, buy your dream home, forever home, take out a 30-year mortgage, which is generally what most people do. It's the most used type of insurance. It's 30-year. And you can then just insure that asset for 30 years for the term policy. And there's some different things. You can do it just, say your mortgage is $300,000. You can do a $300,000 policy for 30 years. You can have it decreasing, so it kind of tracks how much your mortgage is. But this is a way that instead of lumping that into your permanent insurance calculation for, that's possibly income replacement too, but it's a cheaper way. So then you have this extra money each month that you're not paying into a permanent policy. You're still protecting that asset, your house, but you have this extra cushion. That money can be used to save and grow your wealth more. It can be saved for other areas, like if you have kids that need to go to college, you want to fund their college educations, you can save for that. Or if you have college debt yourself, you can be paying more on that by doing this mix and not lumping everything into a very large permanent policy that is not needed. There's another area that most people don't even think about. And if you're a dual income household, if you're married and have kids, it's not likely to be a concern. It's probably lumped into your permanent insurance calculation. However, if you have somebody who stays home, one parent stays home, what happens if that parent suddenly passes? This is childcare costs that I pulled from this past winter from trustedcare.net or .com, one of the two, trustedcare.com. And you can see that really for one child, on average, this is throughout the country, so it does depend on what type of care, where you are, if you choose a center or a home-based or whatever. But the average full-time childcare from birth to age 10 can cost about $56,000 on the low end to $159,000 on the high end. That's going to be if you choose like a Goddard Center or something, one of these large institutions. That's significant. And suddenly, the worst has happened, your spouse has passed away, you have young kids, and then you have to pay all this other money out. You may not have insured the spouse because they weren't working, so you didn't need income replacement. This is an income replacement. This is childcare that costs a lot of money. And most Americans, I think we still have a birth rate, I think it's 2.1 now. It used to be 2.5. So most families have two kids. So can you imagine over 10 years having to pay $150,000 to $300,000 more dollars? Or you could insure that non-working spouse or home-based. It's still work being a parent. I am a parent. I know that one. But we can insure that parent. So if something horrible were to happen, you have a 10 or 20-year policy, depending on how many kids you have, or if you're planning to have more kids, you might want to do 20. So you care for them. You have that money then available to you to pay for that. And that's just an area that a lot of families who have, especially who have that parent at home, don't think about. So phone call coming in. Let's real quick talk about long-term care insurance. This is an area that gets a lot of talk, especially there's a lot of facilities opening up, a lot of people that we see have dementia and things like that. But what's the cost? So this is taken from the genworth.com. You can always get this information. This is 2021. They do, I believe, have the 2023 numbers. There was a pause there for the pandemic when they did the cost survey. This is for the Baltimore area. You can go on genworth.com. It's very easy to find on their website and look at any other area as well and drill down. If you want to stay in Maryland, but go to Western Maryland or you go to a different state, you can look at that too. But these are the average costs of each of those things. It's very, very expensive. And you're not going to necessarily need all of these things. You might start with home health aide or homemaker, adult daycare, things like that, but it could be expensive. The thing is, Medicare doesn't pay for these things. And to have Medicaid pay for it, you have to significantly spend down your assets or give them away. And we've just worked so hard to build all of these assets up and build your wealth. So you may want to look at long-term care insurance. Now, the insurance, it's best to find a financial professional if you have one already, or find one. I'm happy to help if you want, but to look at this and do a cost benefit analysis. You're most likely going to have to pay for long-term care yourself, whether it's through insurance or through your assets. The insurance can be very, very expensive, and it's best, you may be better off self-insuring. You may pay more out into a policy than you would get out of it. So doing that cost benefit analysis with a financial professional is important to do when you're considering this. However, I want to say that if you or family member, parent, whatever, has an old policy, hold on to it. Do not get rid of that policy without talking to a financial professional. There are policies that 10, 15 years ago you could get, you cannot get them, or they're much, much too expensive to get anymore. So Kathleen's coming on and I've talked too long. So I will open it. That's all I had to. That was the end. I'll go to this last one. If you have any questions later on, this is my information. You can always go to katestrom.net. Email, there's a link to set up an appointment with me if you have a question. No strings attached. I'm happy to help. I just like helping people. So do we have any questions?
I actually would like to ask a question going back to the long-term care stuff.
Sure.
So when you say, you self-insure, does that mean that I've heard that some life insurance policies actually have addendums now?
They do.
Okay.
Yeah. Go on. I'm sorry.
You want to explain that for a minute or so?
Sure. So some of the life insurance policies, and these are the permanent life insurance policies, the term ones don't have this. They have what's called, it's usually called like a long-term care rider or advanced benefit of some sort. So if you buy this insurance policy for your life, but if you end up needing care, you can access that benefit earlier. It does tend to draw down your life insurance amount that would pay out at your death, but that could be a way, especially if the long-term care insurance policy, just the long-term care insurance policy, is too expensive.
And I've heard that there's less and less companies even offering a long-term care policy to begin with.
Yes. Another reason why, if you have one or have a parent or a loved one who has one, do not get rid of it. Talk to somebody first, look through it. A lot of these policies that were sold a long time ago, they keep increasing in price because just the cost of care is astronomical. It's gone up so much over the last 20 years. They may have get these notices saying, hey, your benefit, you can reduce your benefit and keep the same cost, or you can keep the benefit and raise the cost. Anytime you get that, talk to a financial advisor. Talk to somebody who knows your situation or can sit down and go over your situation and figure out what's the best thing to do, because a lot of these policies you're never going to be able to get again.
Is there a good age to start thinking about from life insurance to this long-term care stuff to the IRA. Like I know you want people to
IRAs,
invest.
especially when you have, so there are some income limits with a Roth IRA. If you're just starting out saving money and starting out with your career, start a Roth IRA, start whatever, any retirement plan that your company offers, do it, especially if there is a match. A lot of companies match like the first 3% or things like that. That's money that you're leaving on the table by not starting that plan. They've already calculated that they're going to put that amount of your salary away. So that's part of your compensation that you're not taking advantage of. To do that immediately. For insurance, well, life insurance, anytime you have somebody or something that you need to take care of. If you have a child, you have a spouse, you have a house that you want to pass on to somebody, you're going to want to have some insurance for that. Long-term care, you don't want to start too early because then it goes astronomical, but I would say start looking around age 50. 45 to 55 is the general range that you're going to want to look at those policies and see if it makes sense. It may not at all. However, if you do have family history of early onset dementia or something, you're going to want to look early. So that's something to talk to somebody about too, to see
Great.
when.
And we have about 2 minutes left. I just want to throw a question in there about self-employed people. So if you are self-employed, all of the information that you gave is great. Is there anything else that self-employed people should know that you haven't covered yet?
Self-employed people, there are plans just for you. So 401ks can be very expensive. You can do an individual 401k, or if you're self-employed and maybe have one employee, there are some other plans that don't have the costs associated with it. There's simple plans, self-employment plans, things like that. It's always good, like I said, always talk to somebody, but you still want to save. With a self-employment person, somebody who's self-employed, you can do just an IRA, but there are limits. There are annual limits to all of these plans. And something like a simple plan has a higher limit. Now, 401ks have the highest limit. But there's also something called a deferred compensation plan. You need to be self-employed and have a lot of income that you want to put towards that to make that really a good option for you.
Perfect. Well, you gave us a ton of information in a very short time. So
Very
thank
quickly. So
you.
please, if you have questions, like I said, no strings attached. I'm happy to answer any questions, help you in any way I can. And if I'm not the person that you want to work with, and you need somebody and we're not a good fit, I will happily help you find somebody who is.
Well, you can't ask for anything more than that. So, Kate, thank you so much for sharing your knowledge with us during our monthly webinar. Everybody, this is being recorded, so take a look at our YouTube channel, Facebook, all that kind of stuff. You'll see the link posted there if you'd like to share this or come back to it and take some more notes. So, Kate, again, thank you so much. We appreciate everything that you've shared with us today.
Yeah, thanks everyone for coming.
Okay.